Guys, 42% of homes were sold at a loss. This is an outrageous story coming out. There's a dramatic decline in the US housing market that we're all being painfully aware of right now. It's been devastating to builders, to flippers, just about everyone that's planning on selling their homes as rising mortgage rates put an end to the buying frenzy that we saw through much of the pandemic. And the slump has been particularly harsh on Opendoor Technologies, which is a company that considers itself a pioneer of the data-driven take basically on house flipping known as iBuying. And the company sells thousands of homes a month. They lost money on 42% of transactions through August, according to research by YipitData. Opendoor's results were the worst in major markets like Los Angeles, where it lost money on 55% of sales, and then Phoenix, where the figure was actually a whopping 76%. Opendoor has warned investors it expects to lose up to $175 million in adjusted earnings before interest, taxes, depreciation, and amortization in the third quarter. A representative for Opendoor had this to say in a recent statement. He said, "We provided third quarter guidance in our lost earnings to reflect lower than normal transaction volume and price adjustment or home price appreciation, as well as longer than normal hold times for inventory associated with the most rapid change in residential real estate fundamentals in 40 years. We've moved quickly and decisively to prioritize inventory health and risk management." End quote. The firm's turbulent summer is a reminder the price fixing problems that derailed Zillow Group's iBuying business last year, according to research note by Mike Delpreet, an academic in resident at the University of Colorado in Boulder. Delpreet said that Opendoor's metrics are in the danger zone and that they're very close to where Zillow was in their worst moments. That does not mean that Opendoor will close down the business, but it does show the scale of losses and that September last month will probably be even worse than August. The iBuy model relies on buying homes, making minor repairs, and then selling the properties again, usually within months of the initial purchase, so flipping the properties. When house prices were skyrocketing earlier this year, Opendoor was sitting pretty with an easy profit producing model, and then declining affordability, and then the mortgage rates spiking towards 6% in spring of this year finally drove potential buyers off. And by June, the median house price had begun falling in some areas, particularly in the Sun Belt markets, which were seeing their boom days of the pandemic turn really into new bust days at this point. The change took Opendoor by surprise. It left them scrambling to unload thousands of properties that they had agreed to buy as prices were rising. And instead of canceling the contracts, Opendoor decided to honor its offers, which I respect personally. They explained in a letter to investors in August that the decision was an investment in the company's branding. It's basically a reputation preservation decision. Opendoor's stocks have been falling dramatically. They're down 72% year to date through their September 16th close. Eventually, Opendoor will have finished selling through that stockpile that they purchased prior to the market turn, giving it then the opportunity to stop the losses and begin selling homes again at a profit. In the meantime, Opendoor's struggles have been beneficial to some home sellers because they were able to get top dollar for their property before or even as the market was turning. But the good days for sellers may finally be behind us as mortgage rates are continuing to drag down home sales. According to a report recently released by the National Association of Realtors, existing home sales did fall 0.4% in August. That marked the 7th consecutive month decline, and they were down 20% compared to the same month a year ago, with sales down from 5.99 million in August of 2021 to 4.8 million in 2022. Meanwhile, median housing prices, although they're still up 7.7% year over year in August, they've declined 6% in the last 2 months after reaching an all-time record high of $413,800 in June. That fell to $389,000 in August. On average, the 2-month cumulative declines typically are in the 2% range, so that 6% accumulation is definitely out of the ordinary. The last time it fell more than 6%, over a 2-month period was September of 2013 when it fell 6.5%. And with the recent news from the Fed that this most recent 75 basis point rate hike, was happening, things are really going to continue in this fashion for the foreseeable future. As mortgage rates continue to rise, expect to see home prices fall further, but we're not yet at the stage where a massive correction should be completely expected. As a result of the higher rates, home prices have started to soften and sales have decreased. But there's still a shortage of available homes for sale, and that inventory is really keeping the prices where they're at. Now, expect to see home prices fall, but don't necessarily expect a massive correction just yet. For those that are looking for the best deals in the coming months, take a peek at the recent video that we did. I'll put it in the description for you. That's on the most and least vulnerable housing markets right now. In that video, we do share markets that are seeing the most vulnerability in price reduction, while also highlighting the markets that are looking especially secure right now. We're going to continue to bring you the real estate news that matters to you, so make sure you like this video and subscribe to the channel so you're alerted every time we do upload here. Share the video with your friends and family, because this is a particularly exciting time to be exploring real estate and making sure that you're staying as acutely aware of what's going on than possibly ever before. So we'll see you on the next video. Until then, make it a great day today and keep on cash flowing. Take care.